When silver fell hard from its recent highs, the reaction was predictable. Analysts rushed to explain why the move had failed. Commentators framed it as exhaustion. Headlines leaned into finality. The language was decisive, almost relieved, as if a long-standing anomaly had finally corrected itself. But markets do not resolve 50-year distortions with a single violent move, and they certainly do not do it while the most informed participants are quietly positioning in the opposite direction. What most people missed during that decline was not the speed of the fall, but the behavior underneath it. Price collapsed, sentiment evaporated, and fear dominated every visible channel. Yet beneath that surface panic, activity was taking place that had nothing to do with emotion. Large, deliberate transactions appeared repeatedly at key levels. Not random, not reactive, structured, disciplined. The kind of behavior that does not care about tomorrow's headline, because it is focused on conditions years ahead. This matters because silver is not behaving like a normal asset anymore, and it has not been for some time. There are moments in markets when price action stops being the story and becomes a symptom. When movements are no longer about speculation, but about repricing something that has been misaligned for decades. Silver is entering one of those moments. And to understand why, we have to stop thinking in terms of weeks or quarters and instead examine what has been building quietly for half a century. For more than 50 years, silver existed inside an artificial boundary. It oscillated, sometimes violently, but always within the same broad range. Every approach toward the upper edge of that range ended the same way. A sharp reversal, a collapse, a return to familiarity. Over time, that behavior became accepted as natural. Silver was labeled volatile, unreliable, unsuitable for long-term positioning. The market stopped asking why it behaved that way and simply assumed that was its nature. But here's the problem with that assumption. No other major commodity behaved like this. Gold did not remain trapped. Oil did not remain trapped. Copper did not remain trapped. Lead, nickel, even uranium eventually broke free of their historical ranges and established new valuation zones. Each followed the same general sequence. Long compression, a decisive break, extreme volatility, then a permanent shift higher. Silver alone remained frozen in time. That alone should have raised questions. Because markets do not selectively ignore fundamentals for 50 years without consequence. When an imbalance persists that long, it does not disappear. It accumulates pressure. The moment silver crossed above $50 was not important because of the number. It was important because it represented the failure of a containment structure that had held across generations. That kind of failure is not cosmetic. It is structural, and structural changes do not resolve themselves politely. History gives us two clear examples of how silver behaves when it escapes long-term compression. Not theories, not models, actual events. The first occurred at the end of the 1970s. Silver spent months moving quietly, almost unnoticed. Then momentum began to build. At first it looked unremarkable. A gradual rise. Nothing dramatic. Then acceleration took over. Price moved faster, sentiment shifted, and attention followed. And then, right when confidence began to form, silver collapsed violently. The drop was fast enough and sharp enough to convince most participants that the rally had failed. They were wrong. That collapse marked the transition point. What followed was a surge so aggressive that it rewrote silver's reputation overnight. The final phase produced the largest gains of the entire cycle, compressed into weeks. The full sequence, from initial acceleration to peak, lasted roughly 5 months. 3 decades later, in a completely different financial environment, the same structure appeared again. Silver moved sideways for years. Then it began to rise. Slowly at first, then more aggressively. Then came the collapse. Once again, a sharp, confidence-destroying pullback. Once again, analysts declared the move finished. And once again, the decline marked the beginning of the most powerful phase of the cycle, not the end. Different decade, different macro backdrop, different participants, same internal behavior. That repetition matters because it tells us something uncomfortable. Silver does not move randomly during breakouts. It follows a sequence. And that sequence is designed to remove participants before the largest move occurs. Now look at the present. Acceleration began late last year. Momentum built steadily. By early 2026, silver had reached levels that forced attention. Then came the collapse. Fast, relentless, Emotionally brutal. Exactly the kind of move that convinces people to abandon conviction. The timing aligns. The magnitude aligns. Even the psychology aligns. If this is the same structure, then what we just experienced was not failure. It was the midpoint. But patterns alone are never enough. Charts describe behavior, not cause. To understand why silver behaves this way, we need to look at the physical market underneath the financial one. Silver is not primarily a monetary metal anymore. It is an industrial necessity. And the modern economy is becoming more silver-intensive, not less. Every expansion in electrification increases silver demand. Solar energy relies on silver at a scale few people appreciate. Electric vehicles require it for reliability and efficiency. Power grids, data centers, medical equipment, water purification systems, advanced electronics. All of them depend on silver's unique properties. These are not luxury uses. They are functional. Demand is not rising gradually. It is accelerating. Supply, on the other hand, is constrained by realities that price alone cannot fix. Most silver production comes as a byproduct of other mining operations. That means silver output is tied to the economics of metals that have nothing to do with silver's own demand profile. Even if silver prices rise sharply, production does not respond quickly. Mine grades are declining. Costs are rising. New projects take close to a decade to bring online. The result is a widening gap that cannot be closed through normal market adjustments. Above-ground inventories exist, but they were accumulated during decades when silver demand was lower and supply was ample. Those buffers are being drawn down, quietly, persistently, and once they are depleted, there is no rapid replacement mechanism. This is why the recent sell-off is so revealing. During that collapse, large buyers stepped in, not impulsively, systematically. Their activity appeared at specific levels, repeatedly. This is not how speculative traders behave. It is how entities behave when they are securing access, not chasing returns. Silver has begun to appear in policy discussions under a different classification, not as an investment, not as a hedge, but as a strategic material. That shift is subtle, but its implications are enormous. When a resource becomes strategic, markets change. Price becomes less about discovery and more about allocation. The question stops being, is this expensive? And becomes, will this be available? At that point, valuation models break down. This is where the idea of inevitability enters the discussion, not as certainty, but as pressure. Markets clear imbalances through price. When deficits persist and supply cannot respond, price moves until behavior changes. That behavior change can come in two forms: demand destruction or substitution. Both take time. Neither happens instantly. In the interim, price overshoots. This is why extreme targets appear unrealistic right up until they are no longer optional. Of course, no analysis is complete without acknowledging what could derail this outcome. Severe liquidity shocks can disrupt even the strongest trends. Policy intervention can delay repricing. Technological innovation can eventually reduce reliance on silver. And patterns, no matter how compelling, can fail. But risk is not eliminated by dismissal. It is managed through proportional response. The asymmetry here is significant. If silver fails to reprice and exposure is conservative, the downside is manageable. If silver reprices violently and exposure is absent, the cost is not just missed opportunity. It is operational risk for industries and long-term erosion of purchasing power for capital. For manufacturers, the concern is not price volatility. It is supply continuity. For long-term capital, the concern is not timing. It is recognition of structural change. History shows that when commodities break multi-decade ceilings, they do not return to the old range. The market recalibrates and moves on. Silver may or may not reach 300. That number is not the point. The point is that silver is no longer behaving like it did for the last 50 years. And when behavior changes after that long, it rarely reverts. What we are watching is not a rally. It is a transition. And transitions, once underway, do not wait for consensus. The data is visible. The behavior is observable. The risks are real. What happens next will not be decided by commentary or belief. It will be decided by availability, necessity, and competition. Markets always resolve those forces eventually. The only question is who recognized them early enough to respond calmly, instead of reacting later under pressure.